Hi, I'm Melissa Parague with Coldwell Banker, and welcome to my new vlog. Each week, I'll cover things from local events to lending regulations. So stay tuned right now for information and updates on the Fannie and Freddie LLPAs and find out if they affect you as a borrower. Hi everybody. I'm Melissa Parague with Coldwell Banker in Sarasota. And today I have with me Jason Williams with Guild Mortgage up in Tampa, Florida. Hi, Jason.
Hey, Melissa, how are you?
I'm good. Happy Friday.
Happy Friday. Thanks for having me on. I appreciate it.
You bet. We still say happy Friday, right? It's like my week just starts.
Yeah, you
And
got
you're
the
the lender that answers your phone on the weekend, so
yeah,
right?
yeah. You don't have a choice. You've got to. It's part of the responsibility of your occupation.
You got it. So I wanted to talk about a few months ago, I think you remember, I did a video on the LLPAs, the loan level price adjustments um, that were going into effect with Fannie and Freddie. And since then, there's been a lot of a lot of questions, a little bit of confusion and misinformation out there about those adjustments. So I wanted to bring you on and talk about a few things, not just that, but maybe a couple other things on the end, just to kind of clear the air and get some facts and some specifics on what's going on. And we'll start with which programs are affected.
Right. So yeah, these, as you mentioned, there were some subtle announcements that they were coming on May 1st. Lenders are going to be the first to find out about it because they're going to have to make adjustments internally to adapt to the changes. As far as the programs that are affected, it's only conventional loans, which would be Fannie Mae and Freddie Mac. FHA, VA, USDA are not impacted by these at all. So
Good. And then, so like I said, I had in my video, I said that everything took place or it began or these changes were going into effect on May 1st.
right.
So most of these lenders were already implementing the changes in mid-March, right?
Correct. Yeah. So I received an internal notification that we were implementing these. It was around mid-March. And the reason for that for us is Fannie Mae and Freddie Mac will purchase the loans after they're closed. So we have to have our pricing set in advance for a reasonable closing date, right? So if we put a contract in on March 15th, we would have to not have those impacts hit that loan. We've got to close it by May 1st. So what we did is get a little bit in front of it, make sure all the adjustments were in place. If they did close sooner than May 1st, we would credit that back to the borrower. But if it didn't that way, both sides were covered with that.
Right. Good thinking. I think that there was a lot of confusion in that period, in that time period between
Yeah,
March.
there's a lot. It's interesting to kind of be in the know in a somewhat political discussion. I've never had that opportunity before for the most part. And there was some misleading, I wouldn't say false. I don't think any of it was intentional, but the best example I can think of was someone with a higher credit score is going to pay a higher rate than someone with a lower credit score. 100% false. But there are impacts. The impacts
It
mainly
seems like that's
are
how it was written, though, Jason. When I went in and I read the new rule, that was pretty, it seemed pretty clear to me. So I don't know, that was floating out there.
Yeah, it's more fee based, and I totally get why there was confusion. If you're not on this side or you don't do this for a living, there's two impacts to a borrower's risk profile, right? So you've got the credit score, you've got income, but the pricing is structured in a way that you have the interest rate. But then on top of that, there's additional risk layered on top of it. And those are the LLPAs, right? So let's say you have someone that wants to put 20% down and they're an 800 credit score. Let's say they qualify for a 6.25% interest rate. If you have that same scenario, but the customer's credit score is say a 680, that person could get, a 6.25 rate, but they're going to have to pay additional fees for that rate. where someone with an 800 credit score would not. So if you have, say, all things being equal, excluding the credit scores, that 680 credit score may have to pay a point or 2 points. And say a $200,000-300,000 loan, that could be additional 4,000 or 5,000 in costs. They pay for the same rate. So that's the penalty they get for having a lower credit score.
Okay.
Does that make sense?
Absolutely.
Okay. That's exactly what these adjustments are, the loan level price adjustments. That's exactly what I just described. More risk applied to someone's scenario. So that's applied to the transaction through fees, not the actual interest rate itself. Now, there are some ways you can work the numbers. If that person doesn't want to pay the additional fees for that same rate, their rate would be higher. So I think that's where they're coming in, where your payment's going to be higher. But to go back, there isn't a scenario where someone with a higher credit score has a higher interest rate than someone with a lower credit score. It's not there.
It didn't make any sense at all. So
And I see why people basically lost their minds about it. I would have. So that's why I wanted to get that information out to you, and I appreciate you asking me about it.
okay, but this is still the highest or the best rate still, that still went up to 780 from 740, correct? Was that?
Well, here's the core. Like they provided us a grid, and this is actually available to the public through I think it's Freddie Mac, not Fannie Mae, Freddie Mac. So they have this heat grid, right? And it gives you, one side is credit scores, the other side is what we call loan to value, like how much is the down payment, right? And in the center of the grid is where all the heat's at. That means that's where the major adjustments were. Based on what I saw, it was 700 to 740 took the biggest hits, and it was 10 to 20% down in those credit scores. That's where all the red was at. Everything else was kind of it was green or light green, which means there was low level impacts. Some of them actually improved, some of them were no impact. So these adjustments weren't across the board. Like every person that applies for a loan isn't impacted by this.
Right.
One of the main things I did get is it looks like they're pushing people to do lesser down payments and take PMI on their loans. And the reason for that is if there's PMI on a loan, it's less risk for the lender and less risk for Fannie Mae and Freddie Mac because that insurance is there. If someone puts 20% down and there's a default, there's no coverage there. But if they put a 5% down, Fannie Mae is going to get some of that back through the insurance coverage. So that's basically what I got from the grid that I saw.
Okay. So, well, in that, when you start talking about credit scores too, yes, it's such a good thing to remind people that, what you have now, if you're looking at financing something in the next 3 or 4 or 5 months, to get with a lender now, right? To get with, because there's so many things you can do to be more proactive to get you the best terms, right?
Yeah, there are subtle things, and we have, we're not a credit repair company, but we do have some software internally that allows us kind of to provide an if this, then that type, like you pay this card down, this is the score impact that you'll have. And like we were talking about, that grid is, 700 to 740 is where that impact is. If you, let's say you're 735, it could be very advantageous for you to go ahead, take a look now. Let's get you in, the 750 range, 760 range, where those impacts really aren't affecting you at all. I think that's great advice. I always tell people there's never a bad time to confirm your options, whether you're a year out, you're 4 or 5 months out. Let's find out where you're at. There's no cost, there's no obligation, no more guessing. You're going to know if you can buy a house or not. And if you can't, let's get you on a path. If you can, here are your options.
Yeah, and that pre-approval is so important right now,
it's
more than ever.
Yeah, it's I don't know, is anyone in the market even considering?
Not really. Not really. There's still sometimes buyers, they want to say jump the gun, but they get excited about a property or a home or starting to search, and they think they have their numbers lined up, and sometimes it's just always good to have that pre-approval letter.
Well, that's the fun part, right? Let's go out and look at some houses. Talking to me, maybe not as much fun. I
can't say I blame them.
Yeah, I totally get it. And I tell a lot of people that I'm like, look, this isn't the fun part, but this is the most important part based on where you're at right now.
Yeah.
That house you love, doesn't matter what you're willing to offer for it. The question is, I have a lot of people say, well, I don't know if I should buy a house. And I'm like, well, that's the wrong question. The first question is, can you buy a house, not should you? And
Right.
then if you can, you can decide if you should or not. But that first question is, can you, is the most important question to me.
So we had talked about this a couple months ago too, with the interest rates creeping up and the buy downs. Are you still seeing a lot more of that now?
I'm not seeing much of that, at least in my market and my client base, since their rates have retracted a little bit and are expected to continue to through the end of next year. I'm not seeing much of it. Now, I did early on when I was
Right.
getting that information out, but I think people just kind of settled into this is where we're at. Let's get the house. That's the most important thing. We're gonna have an opportunity in the next, 12 to 36 months to improve our position versus, having to ask for seller credits and things like that, which aren't a bad thing. I've seen a lot of contracts with those where you
Right.
can apply that to the money you're bringing, or you can use it to buy the rate down. It doesn't matter to us. So the opportunity is still there. I just less people are taking advantage of it.
Right. Good. Well, that's awesome info. One thing I do want to touch on is the debt to income uh, rule that's out there right now. I know that there's been a lot of press both ways on this, and I get your feedback and get some information from you on it. What's going on with that?
Sorry about the reminder on my Outlook to hear that. So what was going on in addition to the adjustments that we already spoke about?
Mhm.
There was another adjustment, I believe is embedded in the same process, that there was going to be additional loan level price adjustment or fee is what that equates to on the consumer side for debt to income ratios over 40%. Now, a debt to income ratio means your gross income versus your debt. The sweet spot is maybe 35 to 40%. What they were going to do is have a penalty for anyone over 40%, which is I'm giving my personal opinion here. 40% is very reasonable, very approvable. And I'm not getting into why they did it, but it was surprising, and they got the reaction that they should have. A lot of people in our industry were fighting back, and they did for months. And they literally, I just got an email yesterday, they rescinded that portion of the adjustments, which was a big win. So yeah, I was really happy to see that, and that should be floating out to everyone. And I'm sure someone out there will claim credit for it, but I was just happy to see it. So,
Yeah. Well, good. You definitely want to clarify that because there's, like I said, so much information about this.
a lot to absorb right now.
Yeah. All right. Any other hot information you want to talk about, or anything new or upcoming or exciting that's going on and market wise?
Yeah, so I don't know if you work with this product, but we work with Florida Housing, and they have down payment assistance programs, but the Hometown Heroes is a very popular one. We don't have all the details yet, but that's a program for specific occupations. Some of the like for veterans, military, active military, they don't have to be first time buyers. But this program, you can get up to $25,000, which you can apply towards down payment, closing costs. So that's a product that if you can fit and your occupation fits and the loan amount's right, that you can get in for no money, but that's the closest thing you're going to see in this type of market, unless you're, obviously you can go VA or something like that. So they're going to up the 25 to 35, and they're going to expand the occupation base. I want to say the effective date on that is July 1st. So I'll keep an eye on that and let you know once they kind of give us more detail on the occupation. What I've read is the occupations are expanding from what's already there to Florida-based companies, like owned companies, like maybe a local type situation with that. So that would be good. That's something that's getting a lot of
Okay.
interest.
And that's called Hometown Heroes.
Town Heroes, yeah, we've got it. The rates are really good. They're set by Florida Housing, actually slightly below market. It's a really solid product, great for first-time buyers, and a very important aspect of first-time buyers on this program, and actually most programs, is if you haven't owned a house in the most recent 3 years,
Mhm.
you're a first-time buyer. So if you owned a house 10 years ago and you don't think you're a first-time buyer for this program and most of them, you are a first-time buyer, so you can get access to these.
Okay.
And some of them are even if you haven't owned a primary home in the last 3 years. You can have investment properties, but if, let's say you're a renter and you haven't owned your own place for a while, you may be able to get into some of these programs as well.
Okay. So we can wrap now. I wanted to keep this for around 15 minutes. So I think we covered a lot of really good material today. And I really appreciate this conversation. And, real estate, especially Florida real estate, right? It's just always evolving and changing. So let's continue to, keep the facts out there and keep information flowing, and look forward to talking to you again soon.
Sounds good. I appreciate the opportunity. Thanks.
All right. You bet. Thanks, Jason.
Goodbye.